and welcome to ICM's 7th session of the path of trading, the path to professional trading. Today we decided to talk about harmonic patterns, which are considered among the top recognized patterns, and many traders do trade by choosing harmonic patterns, since they happen more often in the market. So I'll be talking about in brief about the basics of harmonic patterns. Then my colleague Sai will be demonstrating different types of harmonic patterns, and then we'll be using the MetaTrader 4 platform to show you how you can just look up for these patterns. So what are these patterns and where they came from? They're usually geometric price patterns found with the help of Fibonacci numbers. So you can just either you have the harmonic patterns that doesn't take into consideration any Fibonacci numbers, and later on there's some of the traders that they tried combining the harmonic patterns with Fibonacci numbers in order to have more precisions on these patterns. They were first established by H.M. Gartley back in 1932. He had a book called Profits in the Stock Market. So he mentioned a 5-point pattern in his book. There are a couple of authors or traders later on. They tried to just add on what Gartley initiated. So they were writing a couple of times about harmonic patterns or different ways or using different methods to maybe have more precision for harmonic patterns. But mainly that was first recognized by Gartley, and then he took it forward. So the primary theory or what's behind harmonic patterns is that the price, there is harmony in price action, meaning that the price and time they have a certain harmony. So these movements they tend to give a certain or to take a certain shape that you can use in order to make a guess, for example, or make a certain prediction where the market could be going. So markets moves in waves, which can support the prediction of the next move. We usually know that the trend consists of waves. So for example, if the market's going up, we have an impulsive wave, a corrective wave, impulsive wave, corrective wave, and this goes on. If the trend is going down, also we have a impulsive wave, impulsive wave, and corrective wave. So by this we have a different perception. So based on this, you can just set where the market could be going. So if you just use, for example, if you have just a bit of knowledge on Elliott wave theory. Elliott wave theory is also similar to this. You have impulsive and corrective waves, and these waves, they can be improved with the help of Fibonacci levels. So also for harmonic patterns, it's almost the same. So the formed or forming shapes are similar to W or M for the 5-point. We have two types of harmonic patterns in general. We have the 4-point or the generic ABCD, or the XABCD, which is the 5-point pattern, or that usually takes the shape of W or M. So usually they are corrective patterns or considered to be corrective patterns. What does this mean? So let's first differentiate between the 4-point pattern and 5-point pattern. The 4-point pattern is just so simple. You have an ABCD move. So A, B, point 1, B, point 2, C, point 3, and D, point 4. So this is for the 4-point pattern. For the 5-point pattern, it's a bit different. It starts with X, and then we have an A. So it's X, A, and then we have B, and then we have a correction C, and then the market moves D. So this is the formation. This is the harmonic pattern that's taking place here. And the move that's expected to happen after is just here. It happens to with the first direction ahead of the key pattern that was taking place. So this pattern, the harmonic pattern here, is just corrective to the wave, and now we're continuing with the same trend that was earlier. So mainly this is just the concept, the bigger concept for harmonic patterns. The Fibonacci sequence, which came in and gave more, or the Fibonacci levels that came in and gave more precision for the harmonic patterns. They were definitely known from the Fibonacci sequence. We talked about Fibonacci tools in our previous session. So it's just very generic. You have a sequence 0, 1, 1, 2, 3, 5, 8. How is this sequence being built? So it's very simple. You just have the two previous numbers. So 0 plus 1 is 1, 1 plus 1 is 2. So here you're just adding these, and then you're getting the result. You add these and get the result. So 3 plus 5, it's 8. 5 plus 8, it's 13. 13 plus 8, 21. and it goes on and on and on. So you can just add the previous numbers. Out of the above sequence, we can derive certain ratios, the ones that we know as Fibonacci retracement levels or Fibonacci levels, retracement or extension. The primary ratio for the sequence is 0.618, and its derivative is 1.618. What does that mean? So if we just have divide certain numbers over each other, we're gonna get the 61.8 retracement. So for example, if we go 21 over 13, you're gonna get 61.8 almost. 34 over 21, you're gonna get almost same ratio. 55 over 34, also you're gonna get almost same ratio. So this is the key ratio or the primary ratio that we have, which is 0.618, and its derivative is 1.618, which usually is the extension for the Fibonacci. So when we're doing a Fibonacci retracement, we have point, for example, A to B. So if we expect a correction to take place here, we draw the Fibonacci retracement. So we expect where the market could be correcting 38.2, 50%, 61.8, etc. So these levels usually they help with the market or predictions where the market could be going next if point B was breached. So A, B, C, and then D, usually it tends for a certain extension, which could be, for example, 161.8, 1236, etc. So these are the uses of the Fibonacci retracement and Fibonacci extensions. So these are the complementing ratios: 0.32, 0.5, 1.41, 2, etc. as it goes on. Harmonic patterns will rely on retracements and extensions. So if we're talking about point A, B, C, D, for example, the ABCD pattern is just a very simple pattern. So we're going to go A, B, okay, and then here we're going to have a retracement where this retracement will decide where the extension is going to be. So this point C and D. And usually point the pattern A, B, C, D will come with a figure that AB would be equal to CD. So this is going to be equal to this move. There is a harmony in this move. So even if you just draw a channel here, it's going to be a channel, a perfect channel. So this is what's behind the ABCD pattern. If we have, for example, XABCD, with the patterns that we're going to be talking about, the harmonic patterns. So we have XA. So B is going to retrace a certain amount from XA. So this is B here. And C is going also to retrace a certain movement from AB. So C here, for example, and then D is going to drop here. So this is the point, and then here will be the breakout of the move. So also, so we have first the retracement, a retracement or a correction for this move, and then here we have an extension for point D, which is also a correction sometimes of point XA. It depends on the patterns, and sometimes we can see that the D point just crossed below X, so this is also one type of the pattern. So by using the Fibonacci retracement and extension, we will be able to have more precision on the pattern. After detecting the formation of a harmonic pattern, the trader must rely on Fibonacci extensions to define the potential reversal zone. So the potential reversal zone is usually earned by having a confluence between Fibonacci levels. So if we're talking about X, A, B, C, so now we're going to point to Fibonacci extensions from A to B, for example, or even retracement XA, to decide where point B could be the reversal point. Since point B could move from here, or point D could be here, or point D could be lower. So we're going to use the Fibonacci levels in order to decide where could be this potential reversal area where the market's going to jump from again and continue the previous trend that was from X to A. So this is just how you can use harmonic patterns. A potential reversal zone usually has a couple of Fibonacci numbers converging, and the harmonic pattern is completed. A trader can filter the PRZ or potential reversal zone by using candlestick patterns, classic technical analysis, support and resistance trend lines, or technical indicators. Meaning that this point D, it can be supported also if this point B is coinciding with happening, for example, is showing also a reversal candlestick pattern, or it is meeting with a certain support resistance, or it's just a point on a trend line, or some technical indicators they're showing divergence, for example, on point D. So we can use these filters to detect the potential reversal zone. So this is the ABCD pattern. So this is the market, for example. Let's take into consideration gold is trading here at 1900 at point A, and then the market dropped here towards 1850, and then we have the certain retracement to point C, and then we have the extension to point D, where A to B and C to D, they were equal to almost 50. So this is a $50. This could be 1875, for example, and then if we're correcting 50%, and then this price would be 1825. So this is how 1825. So this is how the market is expecting the ABCD pattern. This is a bullish pattern. So as I said earlier, that the harmonic patterns are corrective pattern. So this is a correction for a bigger trend usually. So A, B, C, D, and now we're having the move following detection of the potential reversal zone. Also, the bearish ABCD pattern, you have a move, an impulsive move upside, and then a correction, another impulsive move where AB equals to CD, and then the move taking place after D is the one that usually a continuation after this corrective pattern. So here a trader would be expecting to short for the market to go down. Some of the traders, they can just, if you're just so experienced and you're getting familiar with harmonic patterns, you can just try to also expect. So for example, if you're expecting the market to have a certain pattern, you had point A, B, C, so you have these two waves, impulsive and corrective waves, and you can detect the bottom of wave C. So you can just also point where could be point D here. So you can speculate on the long trade from here with a stop loss, certain stop loss down, maybe at point A. So targeting point D and then closing your long here and going short here. So you earn two moves following the formation of the first two waves. It's a bit hard, but some of the experienced traders, they can do it since they're known that they're getting more familiar with the patterns that they are forming along every day. The ABCD pattern, a 4-point harmonic pattern, doesn't start with the next like the 5-point patterns. AB equals to CD. In a bullish pattern, C can be higher than A. In bearish pattern, C can be lower than A. So if you just go like this back, so C can't cross above A in a bullish pattern, and C can't drop below A in a bearish pattern. The bigger the retracement, the smaller the extension. So if, for example, here we have point A, B, and then we have this C, then D is going to be here. Since A, B, C, D since A, B should be equals to C, D. So if C is far from B, definitely. So if we have a bigger correction, the extension is going to be short. So if we have, for example, 76.8 correction, the extension should be somewhere between 23.6, 38.2. However, if we have, for example, 38.2 retracement, the market could be expecting 161.8 and more in terms of extension, where this could be equals to this. So this is the ABCD pattern. The Gartley pattern is one of the basics. It has a certain Fibonacci levels. We start, it's a 5-point pattern. As we said, we have 4-point pattern, the ABCD, and we have the XABCD patterns that are the 5-point patterns. The market was moving up. We had a certain correction, B retraced partial of the move from XA, and then C will have also a correction for AB, and then we have an extension move for D, where D couldn't cross below X. This is for the Gartley pattern, and here's the potential reversal zone where the market is expected to rally higher again, so a trader could enter this trade here and set a certain stop loss. Similarly to the bearish Gartley, the market was moving down, we had a correction B, so for example, a certain percentage, I'm just going to demonstrate now the levels. We go another extension C, which is a correction from point A to B, and then the D is an extension. So we're falling into ABCD pattern, and then the market moves down again. So this is the Gartley pattern. You can see here the Fibonacci levels. So this pattern was published in the Profits in the stock market, and the 5 levels added by Scott Carney. He's the harmonic trader. He's known as Harmonic Traders. He's the one that introduced Fibonacci numbers in order to have more precision have more precision on harmonic patterns. So AB retraces 61.8 of XA. So this correction here is 0.618. So if you draw the Fibonacci from this point to this point, you have 61.8 retracement. And then BC can retrace 0.382 to 0.886. So point C can have between 0.382% or 38.2% to 0.886. So it can just end anywhere between this area here, and then we have the extension D where CD can extend to 1.13 or 1.13 or 1.618 of AB. So if you just draw the extension AB, you can expect point D to take place at the 161.8, and here it could be the reversal zone, and then the market is up. Point D is at 0.786 of XA. So if you just draw the Fibonacci from X to A, this is the 78.6 percentage retracement for the Fibonacci, and then the market is rallying higher. So this is the Gartley pattern. Now my colleague Sai will continue with other patterns, and then we're going to go over the MetaTrader 4 platform to show you how to expect a certain harmonic pattern formation. Sai?
Thanks, Wael. Hello to everyone. Hope you're doing good. Let's move on to the next patterns, like we go into the butterfly pattern. What, as Wael said, it's this harmonic patterns are basically rely on retracement and extension levels. So what level the retracement happens, the patterns will be decided. So when we're going to the butterfly pattern, very simple here. So you can see first we'll go to the description first. So later on come back to your the graph to show how exactly it varies from different patterns. It differs from Gartley basically because depending on the retracement levels where the point D can extend beyond the starting point of X. So as I said, like AB is a starting, like this also has a bullish and bearish type of patterns can be identified easily. Only reason is that like mainly to focus here the retracement levels. So when you say AB retrace to 0.786 of XA and BC can retrace between 0.382 to 0.886 of AB, and CD can extend to 1.618 to 2.24 of AB, and point D, which is a potential reversal zone, which is D, which is at 1.27 of XA. So let's go on to the picture, like you can see that how exactly it happens. So for I said like AB, which is a 0.786% of XA. So if you see XA of 0.87%, which is AB, when AB, which BC is a retracement between this level of 0.82% to 886% of AB. So when see the D has been formation has been confirmed, so CD can be extended, like CD can be extended till to 1.68 of AB. That means from AB it can extend it to 1.61 or maybe like 2.24. So this is a potential point zone where we can going to go for a trend where it's going to be a bullish. It's a bullish type of patterns where this point D is at like nothing like 1.27% of XA. So this is how exactly a butterfly patterns it's formed. And if you're talking about the bearish side, exactly the opposite side of the bullish one. Since the initiated was by a bullish side in the upside direction, this is initiated by the downside trend, which is a downside move. So XA, and again the 0.7%, 8% of XA will be AB, exactly like 0.38% of BC, and which is C and D is exactly the 1.61% of AB. So which is the D is the potential reversal point where the trend is going to be continued further. So this is how exactly. So this is one of the patterns, like it's very easy to understand, but only thing to identify unless you are very familiar on trying to understand how exactly Fibonacci retracement works and the concept about the harmonic patterns. Let's move on to the next type of patterns here, which is a back pattern. So here the same, again the retracement levels plays a major role to form the patterns. So when you say about back pattern, it's similar to the initial Gartley, but definitely a different measurements. As I said, the measurement is a major point to focus here to understand which kind of the pattern it is. So AB retrace 0.082 to 0.50 of XA. BZ can retrace between 0.82 to 0.886 of AB. CD can extend to 1.61 to 2.698 of AB. The point D is a reversal potential zone. Potential reversal zone of is at 0.8868. So we say that if we come back to the figure, like you can see, this is like a AB is a retrace of 0.82% of 50. So that's what I said of XA. So which is a 0.838% or to 50%, which is of XA. And you can see there is a BC can be retraced between 0.82 of 86% of AB, which is almost near to the completing the 100%, which is almost a 0.886 of AB. You see the CD, which is extended to 1.68 of XAB. So from here, it has extended to 1.61 to 2.68. And from here, you can find a potential a point of zone to take your call here on a bullish trend. Same way for the bearish pattern, it's exactly similar to the opposite to the bullish one. Same way the market will be a downside trend. We will identify as the initial trade has been certainly come from down to the downside in formation A, B, and C, and the D, and this is a reversible, potential reversal zone that can start from the D. Almost similar to the butterfly, but slight difference on the closing of each and every retracement level. That makes sense to understand how exactly the market, and also from the D, the reversal, the potential reversal zone is very important, but to extend your profit. So based on this, your profit extension will be keep moving. For example, it can move above your A level, or also it can go further below to the A level of your bearish back. Let's move on to the final one. It's also similar to other patterns, but again, the retracement levels measurements are being calculated here. So for example, like one of the most precious patterns according to the Scott Kearney, he said that the crab pattern is one of the famous, and mostly it's one of the very powerful pattern because the correction, the retracements are very narrow, and a profit ratio is going to be on one side on a greater move of this. The hint of the reversal at extreme, that's what I said, it's completely a one side. It basically happens on the trendy markets, and especially the correction happened after a few days of consolidations. And if you got this type of patterns on a potential reversal zones, it's going to be a very good a maximum move will be seen on the markets. So AB retraced for 0.838 and to 0.618 of XA. The BC can retrace between 0.82 to 0.886 of AB. CD can extend to 2.61 and 3.68 of AB. The point D is be the potential reversal point as of at 1.61. So let's see how exactly it works here. So for example, like you can say AB reacts. This is the initial stage of a bullish trend. So you initiate it from here and you're trying to wait for the correction. AB is made like 0.38% or 618% of XA. And after that, like BC has made a retracement of at least 0.38 to 0.88, almost near to the 100%. And again, there's a big rally seen on the next correction, which is the CD, extend to 2.618. That means that in earlier patterns, the few patterns we've seen, there is almost like a stop happened, the reversal happened, the potential reversal happens on 1 point level or 1 or 2. But here what happened, it almost extended to the 2.61 level, or also maybe you can say 3.6 levels. And this can be a potential reversal point. And since that the market is going to be a very long bullish or a very long trend can be seen when you identify this type of patterns. And this is one of the effective patterns, and it's very like a long-term view, which usually appears mostly on higher time frames like 4 hours, or you can say 1 hour sometimes, or maybe like daily and weekly charts. So we're talking about the bearish crab is exactly opposed to that. AB again 3.8% or we can say 6% of XA, and it can be this is also like 8.886% of AB, and this is the extension to 2 or 3.61 of the AB. So this is going to be a potential reversal point. So that's all about today of the patterns, and from my side. While is going to give you the more explanation about on meta codes, so we have more idea about it. Thank you.
Okay, so if we just set on the platform, there are some programs that they can just help you with detection of the harmonic pattern, similar to the form that AutoChartist do for classical patterns. There are some also programs that can help you by detecting the harmonic patterns. However, it's most likely just to do it manually. So for example, let's take into consideration any movement in the market. You just go for, let's go for the Dow Jones. So for example, if you witness a certain move, for example, point A, XA, for example, the market was going up, XA, B, C. So if you just hinting for a bigger move, so this is X, for example, this is A, So we have X, A, we have B, we have C, and then we have point D. And after point D, you just go for the continuation. So this is D. So this could be a harmonic pattern where the market is continuing to the upside, similarly to the first move. This ABCD pattern took place. How you can make sure this is a true pattern that's taking place? You can just take the Fibonacci level, the Fibonacci tool. You can just draw the retracement. You go from point A to point B. You can see that the market retraced exactly 61.8, almost from the move that took place from here. So the market first retraced 61.8. If you just want to make sure where the market also retraced from this point, we almost had 88.6. So if you just add this, I'm just going to add the 88.6 to so you can see the market retraced exactly 88.6 from point, so C was 88.6 from point AB. And then going forward, AB was almost equal to CD. So if we just have to set a certain extension, so it's somewhere near the 116 level that we talked about. Since if we just draw this, that's almost equal. So if you go for these, they are almost equal in shape. So we had an equal XA, we have an equal ABCD, and then the market continued to the upside, and we're having a bigger move. So if we just go for this again, you can see how it was a very important pattern that was taking place, similar to with just using Fibonacci levels. We were able to detect the pattern that was taking place, and now the market is continuing higher. So if you're just following on the pattern, you would have probably guessed that the market is setting a certain harmonic pattern formation, and this is going to continue to the upside. Definitely, this was perfect with the election results and the fundamental were taking place, but also make sure that this move started before the elections. So this just started ahead of the elections, and then on the elections day we continued the rally to the upside. But also sometimes, since if we just want to take a look at the side from also only technical analysis, so the first belief of technical analysis is that price discounts everything. So it's just also one of the factors that you can take place. For example, this is just what's happening with gold recently. We're seeing a certain move, so you can just start looking for a pattern to be formed or a pattern to be taking place similar to harmonic patterns. What you have to do for harmonic patterns is just very simple. You just need to set certain expectations for the market where we're going. So just if the market is going up, you have a point from X to point A. The market is going up clearly, so you just set a Fibonacci retracement here, and then point out where point B could be heading. So if point B ended at 61.8 retracement, okay, 61.8 retracement. Now I'm going to wait for point C where it should end, for where the retracement should extend. So if point C also got a certain Fibonacci retracement that is among the requirements of a certain harmonic pattern. Now I have one point, another point in place. I'll just start looking for where point D could be stopping, and based on this, I have to take a certain risk to initiate a trade with a certain stop loss and set a certain take profit that could be maybe point C or even higher. So this is just a very simple approach to have it. So for example, this is the euro. I'm just going to take the euro dollar as an example. So if the euro dollar is moving down now, okay, so this is point. We're starting a point, for example, point X. We're starting a move XA. So let's take into consideration that point A ended here, and now we're heading for a certain correction. So what I have to do is just draw a Fibonacci retracement here. If the market moved upside, where point B is going to end here, okay. Now what I have to do is just go to the other way and just to draw another Fibonacci from this point to this point. And by this, I now expect where point C could end. And if point C ends here, now I have 2 points, 1 and 2, they were chosen by a Fibonacci level. and then the market started moving higher. So what I have to do here is I just take the extension. So I delete this. I go for an extension from the top to the bottom. So these are the levels where point D could be heading. So if this continues here, and I expect a certain point D to end here at 161.8, and I have here also a reversal formation, and I have this level is also matching with the previous resistance zone that was holding the market for a while. So it is worth taking a certain risk where I expect the market to move down again and go for the previous direction. So this is here point A, B, C, D. I have a formation X, A, B, C, D with all the Fibonacci levels set, and the market is moving in a certain direction. So this is how you can just assume how the market is trading and whether we're having a certain harmonic pattern where I can benefit from or not. So it's very easy to use. It's very easy to just put the expectations. And every trade you have to set a certain risk. And it is for harmonic patterns, it is good to base your trade on a certain wave move that could help you in detecting where the market could be going. So this is all for today's session. If you have just a question, please write it down. I'd just like to remind you that all the information, use, analysis, and opinions mentioned in this webinar only serve for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. Perfect. I believe this is it for today. Sai, do you have anything to add?
Perfect. Thank you to everyone.
Perfect. Thank you everyone for joining. If you have any questions, please you can send an email to webinar@icm.com and we'll be glad to help you. Thank you so much for joining and have a safe trading week.